Good afternoon, everyone. I'm Charmaine. I'm very delighted to be able to share and represent iFAST research team today. So today I'll be taking a moment to share our insights on the real estate investment trust landscape in Singapore. So the sector has been challenged with higher financing costs and adjustments on property valuations. Considering that companies actually secured lower cost of debt during the pandemic relative to right now, we believe there are certain potential downside risks that has not been factored in. And our recommendation to investors is to adopt a selective approach when it comes to S-REIT. As we navigate through this intricacy, the importance of staying selective becomes paramount in ensuring a prudent and well-informed investment strategy in the ever-evolving S-REIT space. So, can I have a show of hands? How many of you love S-REITs? Okay, that's like 1, 2, 3, 4, 5, 6, 7, 8. Okay, 9 and 10. Okay, thank you so much. Yes. So yeah, please hear what I have to say about this. Yes. So let's travel back in time. So back then, maybe I will just use the benchmark of Singapore REITs by using the FTSE ST REIT index to kind of showcase the trend last year. So we see that fears were present throughout 2023 till October, midpoint of November maybe. And we see that this trend actually pivoted around mid-November and continued its upward momentum into December 2023. So is it a good time to now join the S-REIT since now that the market has actually pivoted? We acknowledge the emergence of investment opportunity within this sector, but we still think that it's crucial to adopt with caution because not all opportunity align with our attractiveness criteria at their present valuations. One significant challenge persists in this space, and we firmly believe that it has not been priced in yet. So this is the key challenge that we believe has not been priced in yet. We believe that many S-REITs are actually subjected to being compliant to the MAS regulatory leverage limit. So we know that during the pandemic, before the pandemic, we know that S-REIT are actually subjected to a leverage limit of 45%. But during the pandemic, MAS actually stepped in and say that, hey, maybe we should increase the debt headroom so that allow a bit of flexibility for S-REIT to navigate these very uncertain market conditions. So it actually got increased to 50%. But this is only if the S-REIT actually maintains an interest coverage ratio of 2.5 times. So the interest coverage ratio for the actually refers to the net property income per dollar of interest expense. So naturally, if the company has a high interest coverage ratio, it will mean that it is more likely for the company to be able to meet the financial obligation at its net property income level. So before venturing into any S-REIT investment, it's important to ask yourself, what is the interest coverage ratio of the REIT? Because this crucial piece of information will be able to tell you whether this REIT is actually well able to comply with MAS regulatory leverage limit. So the subsequent question is equally crucial. Does it stand at least 2.5 times? If yes, fantastic. Our children S-REIT will possess additional debt headroom. But let's say if it is less than 2.5 times, then this would mean that they are still subjected to the old leverage limit of 45%. So does it stop there? No, we don't think so. Because other than near-term refinancing risk being not priced in yet, we believe that another key risk persists, and that is cap rate expansion. Because this would challenge property values and increase leverage, and therefore diminishing any debt headroom the REIT might have. So I guess it's getting a bit boring. So how about let me illustrate to you through the use of our stress test. So I actually did a stress test on the top 10 S-REIT by market cap. So probably you all see some familiar names here, right? So do you all have any of these inside your portfolio? Do you all have it? Can I have a show of hands? Anyone? Okay, that's a lot of people. Okay, yes. So yes, I'm doing a stress test on the top 10 S-REIT. So the first layer will actually be cap rate expansion. So we believe that, as what I mentioned earlier, cap rate expansion is actually very important because it will affect the property values. And it being affecting the property value, it can directly affect the leverage limit of the S-REIT itself. So we look into the impact of 1% increase in cap rate on this S-REIT. So we see that actually the S-REIT that is most affected by this 1% in cap rate expansion is actually Suntec REIT and Keppel REIT. And we can also see that after this is affected by the 1% increase in cap rate expansion, we actually calculated what is the available buffer after cap rate expansion. And we see that actually some of them will breach the MAS regulatory leverage limit as highlighted in the red bars on the right graph. So you all can see that. And also it's important to note that Suntec REIT is currently being subjected to a leverage limit of 45% instead of 50% because their interest coverage ratio currently is already lower than 2.5 times, even before this stress test. So we believe that, as you can see over here, on the more positive end of the spectrum, we saw that Frasers Logistics and Commercial Trust actually emerged as a star because they boast the greatest buffer of 29%, with its adjusted leverage ratio being the lowest among the top contenders. So is it time to consider investing in Frasers Logistics and Commercial Trust? No, the answer is no, because we still have to look into the second thing and the second layer, and that is refinancing risk. So we believe that this is not priced in yet because certain REITs are still currently having a low cost of debt, and this means that the current interest environment, right, is the effect of it hasn't actually go into the REIT itself. So it is important to look into refinancing risk. And we see that so we actually look into like some of the REIT that has many near-term debt that's going to mature in this year and next year. And seeing that some of them having like a huge weight of debt that's maturing in the near term, it would mean that they actually will be more sensitive to interest rate changes. And also, some REIT, as you can see over here in the gray bar, some of it actually has a low interest rate right now. So this actually tells us that that effect of the current interest rate environment hasn't come into it yet. Because during the pandemic, they actually managed to lock in their debt at a low cost of debt. But now, in the nearer term, it's likely that they have to refinance it. So we can see that Frasers Logistics Trust, just now we actually quite like it, right? But in this case, we see that they will actually face one of the highest increase in cost of debt upon taking into impact of the near-term refinancing risk. And we also see that how this will actually affect their interest coverage ratio, as I mentioned earlier, because MAS need to see the interest coverage ratio being at least 2.5 times before they are actually subjected to a 50% leverage limit. So we see that some S-REIT will actually downgrade to 45%, as highlighted in the red bars over here. And these are Mapletree Peninsula Commercial Trust, CapitaLand Escort Trust, and Suntec REIT and Keppel REIT. And do they have available buffer at those leverage limit? The answer is actually no, they don't. So we believe that with both cap rate expansion risk as well as near-term refinancing risk, these S-REIT are more sensitive to all these downside risks, and we believe that these have not been fully priced in yet. So what is going to happen if, let's say, happen to breach the leverage limit? So the first thing that can happen is that there might be a distressed sales of properties, which can cause a ripple effect in the market and widespread falling property valuation, and it can even cause the net property income of their REIT to fall. The next thing is equity fundraising can be another potential way they can do to try to lower their leverage. So it may not be attractive at current valuation, and unit holders could face dilution. And the third point is that they might even abandon their distribution policy, and upon breaching its debt covenants, it can hurt the return potential for investors. And so we know that this has actually been shown in the past year. So the case study that I want to run through is Manulife US REIT. So firstly, we believe that because of the pandemic in the US, more companies are realizing that there's cost-cutting measures. People are actually working quite efficiently at home. They don't really want to return back to the office. They want to continue remote working. And this change in trend actually causes an impact on the market. And it also causes the fall in demand for US offices. So this can actually affect certain REIT that are pure play US office REIT assets. So in this case, Manulife US REIT is quite heavily affected because of this trend. So with this, the property valuation of the REIT actually experienced a decline in 2022 and 2023 due to the changing dynamic in the demand for office spaces in the US. And in July last year, Manulife US REIT actually, their gearing actually surpassed MAS regulatory leverage limit, and it triggers a breach of financial covenants. And subsequently, they have to make the difficult decision to abandon its distribution policy and signaling financial distress. Facing a challenging situation, the REIT actually attempted to divest some of its assets, but these efforts were unsuccessful. But the good news is that the sponsor actually steps in with the recapitalization plan, and they managed to actually, come up with like some agreements with their debtors, and then come up with like better credit arrangement with them, so that they can try to navigate out this situation like well. So after hearing all this, can you make a guess? Who is the most resilient S-REIT? Will it be Mapletree Logistics? Will it be Keppel REIT, Suntec REIT, or CapitaLand Ascendas REIT? Okay, the answer is actually CapitaLand Ascendas REIT. So yes, that's the star performer of our stress test. So if you have this in your portfolio, good for you. So the reason being why we choose CapitaLand Ascendas REIT is because, yes, it managed to sustain our stress test, and looking against its large cap peers, right, like Mapletree Industrial Trust and Mapletree Logistics Trust, we see that it actually have a sizable buffer of 14%, larger than its large cap peers. And they also actually experienced the smallest change in cost of debt relative to its peers after taking into the near-term refinancing risk. So this actually suggests to us that it is less sensitive to near-term refinancing risk, and considering both cap rate expansion and near-term refinancing risk, we observe that CapitaLand Ascendas REIT enjoys a healthy margin of safety. And these factors further convince us of the REIT's resilience and lead us to recognize that it is a noteworthy player in the S-REIT landscape. So another thing that will drive like CapitaLand Ascendas REIT is also supply chain tailwinds. So why is that so? So this is because there's a huge portion of like their property being in logistic assets, and we can also see that the rental index of industrial properties in Singapore for warehouses actually has the most steep gradient in terms of their index, and this will mean that the rate of increasing in price of the rental index kind of show a potential rental reversion for CapitaLand Ascendas REIT assets. So this actually is also driven by the high demand and diversification of supply chain and rapid expansion of e-commerce. So the data actually suggests that CapitaLand Ascendas REIT stands to gain from these supply chain dynamics, positioning itself favorably for potential rental reversion growth in the evolving market landscape. So a potential question you might have is that, what if now that COVID has somewhat ended, and maybe the construction is actually resuming, and maybe the incoming supply coming online this year might affect the demand for their logistical assets. So we see that this year, some of these assets, in the near term, some of these assets were actually coming online, but this actually only makes up only 5% of the existing supply. And given this relatively small portion, we anticipate that the new supply will exert only a marginal impact on rental rates. And the sustained high demand driven by the diversification of supply chain and the growth of e-commerce is expected to overshadow any potential downward pressure on rental rates. Now, let's look at a closer look at CapitaLand REIT rental reversion against its large cap peers. So this graph actually illustrates that CapitaLand Ascendas REIT has consistently outperformed its large cap peers, with quarterly rental reversion showing a positive trend from first quarter 2021 to third quarter 2023. And this robust rental reversion are largely attributed to CapitaLand Ascendas REIT logistic properties in Singapore. As of third quarter 2023, CapitaLand Ascendas REIT actually boasted an impressive occupancy rate of 99.2% for its logistic assets in Singapore, surpassing JTC industrial average of 91.3% by a substantial margin of nearly 8%. And furthermore, CapitaLand Ascendas REIT occupancy rate actually outshined its large cap peers with Mapletree Industrial Trust and Mapletree Logistics Trust standing at 93.2% and 96.9% respectively. So with strong rental reversion and occupancy rate, CapitaLand Ascendas REIT actually demonstrate the continuous strength and performance of its portfolio. So the next point is that, as we can see from Manulife US REIT previously, we know the impact of how having a strong sponsor can protect and give more credibility to the REIT itself. So for CapitaLand Ascendas REIT, as the name suggests, they have a strong sponsor, and that's CapitaLand. And by having a strong sponsor, they can pave the way for future acquisition. So last year, we actually see that CapitaLand Ascendas REIT actually did quite a few acquisitions and also some divestment. Just a point to note that the divestment is not at a discount and it's in fact at a premium. And also by having the way to pave the way, having the sponsor to pave the way for future acquisition, it also can mean that is a potential growth driver for the REIT as well. Because we know that having quality assets, it can also boost their MPI and also hopefully their distribution. And we can see that, secondly, another point is that having a strong sponsor will also impose financial discipline on the S-REIT itself. So we can also see that CapitaLand Ascendas REIT gearing versus its peer average, we can see that it is much healthier as compared to them as well. So now let's look at the valuation, the share price, and we can look at the chart, the share price versus the distribution per unit. So we know that distribution is quite an important point for S-REIT investors as we look into their distribution because it provides us with somewhat a fixed stream of income. So by doing a dividend discount model with a terminal growth rate of 2% and cost of equity of 7%, we arrive at a target price of $3.14 and an average forward dividend yield of 5.36%. So with that, in conclusion, we believe that the challenge of complying with MAS regulatory leverage limit has not been fully priced in yet, and many S-REIT actually are at risk of breaching the MAS regulatory threshold. And because of that, we also look into the stress test, and we see that some S-REIT actually have insufficient buffer and or face greater near-term refinancing risk, which will further challenge their ability to comply with the regulatory threshold. And on the last point, we believe that you should stay selective in this space and be mindful of potential financial implication if a S-REIT breaches the regulatory threshold. Because if they breach it, they can cause distress, property sales. It can also cause equity fundraising, which can dilute your ownership of these shares. And also, we see that they might even abandon their distribution policy if, let's say, they were to breach the MAS regulatory leverage limit. And finally, our recommendation, our shelter in this S-REIT storm is actually CapitaLand Ascendas REIT. Reason being, it's a star performer in our stress test. It has supply chain tailwinds and is backed by a strong sponsor. So with that, thank you so much for listening to me, and I hope to see you at the FSMOne booth. Yeah. Thank you.